Investors woke up to a sea of red this morning. Target, the retail giant, just announced a massive earnings miss for the third quarter. This sent shockwaves through Wall Street, with their stock plummeting over 10% in pre-market trading. This is a big deal, folks. Target's earnings per share fell drastically short of analyst expectations. This miss is a major blow to the company, especially after their strong performance last year. Investors are understandably concerned about what this means for the future. Is this a blip on the radar or a sign of bigger problems to come? Let's break down the numbers to understand the severity of this earnings miss. Target reported adjusted earnings per share of $1.54, significantly lower than the $2.16 analysts had projected. Ouch! This represents a whopping 29% decline compared to the same period last year. Revenue also fell short of expectations, coming in at $26.52 billion compared to the anticipated $27.97 billion. This miss, while not as drastic as the earnings per share shortfall, still paints a picture of slowing growth for the retail giant. Adding to the concerns, Target slashed its full-year earnings guidance. They now expect adjusted earnings per share to be in the range of $7 to $7.20, a significant drop from the previous guidance of $7.75 to $8.75. This downward revision reflects the challenges Target anticipates in the coming months, particularly during the crucial holiday shopping season. Cornell didn't sugarcoat the situation. He acknowledged that Target is facing some serious headwinds. High inflation is forcing consumers to make tough choices, and discretionary spending is taking a hit. People are thinking twice before splurging on non-essential items, which is bad news for Target. Cornell also pointed to increased costs as a major factor in the earnings miss. Supply chain disruptions continue to plague the industry, driving up transportation and logistics expenses. Target is also grappling with higher labor costs as it competes for workers in a tight labor market. Another challenge Cornell highlighted is the aggressive discounting strategies employed by competitors like Walmart. In a bid to attract budget-conscious consumers, these retailers are slashing prices, forcing Target to follow suit and squeezing its profit margins. So, what does the future hold for Target? The stock market's reaction reflects the uncertainty surrounding the company's prospects. Analysts are divided in their opinions, with some expressing cautious optimism, while others remain skeptical. Some analysts believe that Target's strong brand recognition, loyal customer base, and investments in its omnichannel capabilities will help it weather the storm. They point to the company's continued growth in digital sales and its success in attracting younger, more digitally savvy consumers. However, other analysts are less sanguine about Target's future. They argue that the company is facing an uphill battle against persistent inflation, fierce competition, and shifting consumer spending patterns. They believe that Target needs to do more to differentiate itself and offer a compelling value proposition to regain investor confidence. The coming months will be crucial for Target as it navigates these choppy waters. The holiday season will be a key test of its ability to attract shoppers and drive sales. Investors will be closely watching to see if Target can regain its footing and restore its reputation as a retail powerhouse.